The major issues are, number one is finding the right partners. Number two is, how do I figure out all of the different regulations and what are the hidden regulations? In other words, transparency is a very big issue. The third one is, are there people or companies like us already doing business there? So what's the competition look like?
I think another challenge is the uncertain policy environment, particularly when you're working in multiple countries. So the home country that you're then based in is fine, but then the countries surrounding that you're exporting to are changing their tax rules or changing their customs rules, and that can really throw off a business plan. So that you have to be careful of.
A lot of challenges that we would take for granted here in the United States. I mean, power, infrastructure, physical infrastructure, roads, transportation, getting things to market, logistics. Logistics is something that really has to be thought through in frontier markets. When you're exploring the business plan as an institutional investor, how well developed are their logistics plans and operations? Are they efficient? Can they be optimized? That's a huge challenge.
One concern that is a valid concern that a lot of investors have is liquidity risk. And this is really you put in investment into a company in Africa, and your ability to exit that investment is probably going to be more challenged in Africa relative to other markets elsewhere in the world that just have a lot more liquidity.
Here in the United States, we have the novelty of discussing flash trading. We're seeing a lot of high-frequency traders, and that would be a great thing to have in frontier markets where we actually had the volume and the liquidity provided by increased capital flows. But secondary market liquidity, I think, is very important to attract capital, along with the legal infrastructure to protect those property rights.
At one level, there is just a function of operating in a frontier market that's less liquid. That said, there are ways in which we can work with investors in order to address those specific concerns. So it may be in the way in which a particular transaction is structured. It may be potentially guiding them toward opportunities that are good cash flowing opportunities, so that their investment basis, if you will, is significantly reduced over time, over the period of time that they hold the investment.
And so when we advise companies, we encourage them to take the broadest possible look at the market and not just look at their narrow sectors, because most of the leaders in these companies are concerned with human, economic, and social development very broadly. And the industries that they promote only contribute a bit. So they're looking at the larger picture, and I think companies that look at the larger picture will have a leg up in terms of doing business in Africa.
I would say everywhere in the world, you have to be careful of who are your partners, and you need to do very deep integrity checks on your partners. We do that in all countries, all around the world. And it's just as important in Africa as it is everywhere else in the world.
I think one of the important things to remember about investing in Africa in particular relative to investing in more developed economies is that we found that the gestation period for transactions is a little bit longer than investors find elsewhere in the world.
Doing your first deal in a market takes a long time, whether it's in the power sector, in agriculture, or finance. The theory is, and I've seen this work in our investments, is that the first one takes the longest, but it's the follow-on opportunities that provide both the greatest upside and also can happen a lot faster.